New York City, autumn 1929. The trading floor is loud but strangely euphoric. Brokers shout, paper flies, prices surge. Margin debt reaches levels never seen before. For years, Americans were told a new era had arrived, one powered by credit, speculation, and permanent prosperity. Weeks later, the Dow Jones collapses nearly 90%. Banks fail. Credit vanishes. The debt that once amplified growth begins amplifying destruction. Every debt economy follows a pattern, and history suggests we are closer to its final stage than most people realize. The modern world runs on leverage. Governments borrow to stimulate growth. Corporations borrow to expand. Households borrow to consume. In moderation, debt is a tool. In excess, it becomes a structural trap. The myth is simple: more debt always leads to more growth. The reality is more mathematical. When debt grows faster than productivity, the system eventually reaches saturation. At that point, new borrowing no longer creates new wealth. It merely postpones recognition of losses. The final stage of a debt economy is not dramatic at first. It is subtle, it is gradual, and then it is sudden. There are four structural phases that appear again and again throughout history. Expansion through productive debt saturation and diminishing returns, financialization and asset inflation, monetary rescue and currency devaluation understanding. These phases is not prediction, it is pattern recognition. Phase 1 begins optimistically. Debt funds real productivity infrastructure, industry, innovation. Post-World War II. America is a textbook case. Borrowing financed highways, factories, and suburban expansion. GDP growth outpaced debt growth. Living standards improved. Debt, in this stage, creates future income sufficient to repay itself. But Phase 2 begins quietly. As economies mature, opportunities for high-return investment decline. Growth slows. To maintain expansion, policymakers encourage more credit. Household leverage increases. Corporate buybacks rise. Governments normalize deficits. Debt grows faster than income. Japan in the late 1980s offers a warning. Real estate and equity markets soared as credit expanded aggressively. Asset prices detached from underlying productivity. When the bubble burst in 1990, Japan entered decades of stagnation. Despite near-zero interest rates, growth never fully recovered. The debt remained. Then comes Phase 3, financialization. In this stage, debt no longer funds production. It funds asset prices. Stock valuations climb not because earnings surge, but because liquidity floods markets. Real estate prices rise. Because mortgage credit expands. Wealth appears to grow, but it is largely balance sheet inflation. This phase feels prosperous. Inequality widens. Asset holders thrive. Wage growth stagnates. The economy becomes dependent on rising prices to sustain confidence. The United States in the 2000s embodied this dynamic. Mortgage-backed securities multiplied. Housing prices accelerated. Household net worth rose on paper. Yet underlying wage growth remained modest. When credit conditions tightened in 2007, the illusion unraveled. The 2008 financial crisis was not merely a housing event. It was a debt saturation event. After such crises, one might expect deleveraging. Instead, Phase 4 emerges. Monetary rescue. Central banks lower interest rates. They purchase government bonds. They expand their balance sheets. Liquidity replaces solvency. Debt is refinanced, extended, and socialized. The private debt problem becomes a public debt problem. After 2008, global central banks injected trillions into financial systems. Asset markets recovered rapidly. Government debt soared. Interest rates approached zero across advanced economies. What was once considered emergency policy became structural policy. Here lies the final stage. When debt levels become so large that raising interest rates threatens systemic collapse, monetary authorities face constraint. They can no longer normalize policy without destabilizing the system. This creates three long-term consequences. First, suppressed interest rates distort capital allocation. Zombie companies survive on cheap financing. Productivity weakens. Second, asset inflation becomes policy-dependent. Markets respond less to earnings and more to central bank signaling. Third, currency debasement becomes the silent adjustment mechanism. History shows that heavily indebted societies rarely default outright. Instead, they inflate. In the 1970s, advanced economies experienced high inflation as governments accommodated fiscal deficits. Savers lost purchasing power. Real wages stagnated. Hard assets preserved wealth. In more extreme cases, such as Weimar, Germany, or more recently Venezuela, currency collapse erased savings entirely. These are extreme examples, but they reveal the direction of pressure when debt exceeds productive capacity. Today, global debt exceeds $300 trillion, more than 3 times global GDP. Government deficits remain structurally high. Demographics in developed nations are aging. Productivity growth remains modest. Entitlement obligations expand. Interest rates, after briefly rising in response to inflation, already show signs of political and financial sensitivity. Markets react sharply to tightening. Governments face escalating interest expenses. The final stage of a debt economy does not necessarily mean sudden collapse. It often means prolonged stagnation, financial repression, and gradual erosion of purchasing power. There are only 4 historical resolution paths: default, austerity, growth, outperformance, inflation. Default is politically destabilizing. Austerity is socially unpopular. Sustained high growth is rare in mature economies. Inflation, by contrast, is subtle. It reduces the real value of debt over time. It transfers wealth from savers to borrowers. It rewards asset ownership and penalizes idle cash. The question is not whether collapse is imminent. The more relevant question is whether the system has entered its late-stage dynamics. Signs of late-stage debt economies include persistent deficit spending even during expansions, central bank balance sheets that never fully contract, asset valuations detached from historical norms, rising wealth inequality tied to financial assets, political polarization around redistribution. These are not headlines. They are structural indicators. For investors, the implications are sober rather than dramatic. In debt-heavy systems, nominal returns can appear strong while real returns erode. Diversification across productive assets, inflation hedges, and global exposures becomes critical. Cash loses silent purchasing power when monetary expansion persists. Fixed income suffers when inflation volatility rises, but panic is rarely productive. Debt cycles unfold over decades, not weeks. The Great Depression reshaped financial regulation. Post-war debt was reduced partly through growth and partly through moderate inflation. Japan's stagnation demonstrates that collapse can manifest as slow erosion rather than sudden implosion. The final stage of a debt economy is not defined by chaos. It is defined by constraint. Policy flexibility narrows. Growth becomes harder to generate. Monetary intervention becomes habitual. Wealth concentrates in assets tied to liquidity expansion. The deeper lesson is philosophical. Debt is a claim on future productivity. When a society overextends those claims, it borrows not just money, but time. Eventually, time demands repayment. No economic system escapes arithmetic. But societies adapt, they restructure, they inflate, they reform. The danger is not debt itself. The danger is complacency within its late stages, because the final phase never announces itself as the final phase. It feels manageable, it feels extended, it feels sustainable until it isn't. And by the time the recognition arrives, the adjustment is already underway. History does not repeat precisely, but it rhymes with mathematical consistency.